Okay, so I'm doing the economic crisis, the U.S. versus the EU. So first we're going to talk about the background of the U.S. economic crisis. How it all started was in 2006. We had a housing bubble, which meant in 2006 the prices were going up, and then they just kind of stopped. And then in 2007 the prices started going down. And all the prices dropping meant an increase in foreclosures. And all the foreclosures meant lenders would lose out. And all the lenders losing out meant they would stop giving out other types of loans also, such as consumer loans, commercial real estate loans, corporate loans, et cetera, et cetera. And our economy depends on all these loans. So without all these loans, our economy started going into recession. And the cartoon shows how no one wanted to call it recession. It was a slowdown, because if they said recession, it would just spiral out of control even faster. So then we look at how the U.S. has responded to it, and first we have the Federal Reserve's response. And at first what they did was they lowered short-term interest rates and increased loans to commercial banks, but this didn't work. So then what they did was they expanded the eligibility of collateral for its loans. Before you can only use treasury bonds, they started allowing more riskier things to be eligible. And this showed just how bad everything was, because the feds went beyond their normal area, and justifying was saying the financial system of the U.S. was at risk, and therefore it was okay for them to do all this. And also in September 2008, AIG was in huge trouble, and so the feds went ahead and bailed them out. They bailed out a lot of people, but this is particularly big because they feared that if AIG went under, they wouldn't be able to cover everything they had lent out, and also AIG going under would push everyone else more into recession because they were so big. In February of, and the feds have helped the crisis, but they haven't actually solved it really. I mean, you can see where we are now. We have Congress's response. In February 2008, they passed economic stimulus bill of $168 billion, and include tax rebates and tax cuts. It helped everything, but it was only a temporary help. So they passed another economic stimulus bill in 2009, and this was called the American Recovery and Reinvestment Act of 2009, and that's even more money that's supposed to be spent, I think, through 2019. It's more of a long-term picture. And in July 2008, Congress passed an Anti-Foreclosure Act, which would allow for refinancing. As I said before, the foreclosures affect loans, which affects the economy, so that's what they're trying to prevent with this act. And also in September 2008, the Treasury Secretary had asked for $700 billion, which Congress approved, to purchase high-risk mortgage-based securities from U.S. banks to help them out because all the banks were in trouble. And here we have a cartoon of Obama milking the U.S. Treasury for all it's worth for AIG and autos and banks and housing, and just trying to help their economy. And so you guys can kind of assess for yourselves where you think we are, if they've done a good job or not. I mean, they have stopped it from spiraling out of control, but we're not exactly where we were before. So, soon take. We also have the EU and their background. As you know, it kind of started with Greece, which came over from the US, kind of. And Greece has large public deficits, as was talked about before, and their largest industries are tourism and shipping, and those were affected by the global crisis that we were all experiencing. And Greece lied about their economic conditions, and it all came out in January. And in January, the debt was estimated in Greece to be about 216 billion euros, and they have their high tax evasion rate. The S&P had announced that everything was pretty much junk, and investors would lose 30 to 50% of their money, and after that, the stock markets fell in response, and about 70% of their bonds were held externally. And here it shows that after Greece was going down, then Ireland, then Portugal, and Spain, so on and so forth, and they say, well, there goes the neighborhood. And also, it's actually affecting the Asian stock markets after it just recently went down again in Asia because of Ireland. And so, because of Greece and Ireland, Asian markets are tumbling. So, how the U.S. affected Europe may now affect Asia. Like, we'll have to wait and see how that goes, really. And then you have the EU's response. And the European Central Bank on March 5th suspended the minimum threshold for Greek debt, which means bonds will still be eligible for collateral. They're just trying to prevent things. Actually, a few days before that, Greece, the Eurozone, and IMF gave Greece a loan of 45 billion euros, and more was added to it, totaling 110 billion euros. On May 9th, they created a European Financial Stability Facility. It was aimed at helping to preserve the financial stability of European countries that might be at risk also. That was how they were trying to preemptively help other countries. However, it's been said that they're going too slow with helping everyone, with Greece and with Ireland. They want the countries to do it themselves. However, the countries doing it themselves, since they only have fiscal policy, they don't have the monetary policy, it's very hard for them to do it themselves. In September 11th, the IMF approved the second part of Greece's bailout package of 6.5 billion euros, and Greece's financial troubles are spreading. In recent news, November 21st, a few days ago, Ireland accepted the EU IMF package to help with their debt. It was billions of euros, and and all the fee increases and wage cuts in both Greece and Ireland have caused civil unrest. So hopefully, if that continues to spread towards other countries, everything's get out of control. And actually, in today's news about the EU's response was how Ireland's affecting Spain and Portugal. Portugal's benchmark stock index went down 1.8%, and Spain's fell 2%. The euro is now below $1.34 to the US dollar, which is the first time in 2 months. Portugal is 2% of the Eurozone economy, but Portugal then affects Spain. And they think that Portugal will ask for help from the EU by the early next year. And Portugal is right now about to pass in their parliament a package to help them with tax cuts and pay cuts, tax increases and pay cuts. And that was started to be prepared in January and is expected to pass actually this Friday. So we'll see exactly if this works or not, because with the economy you can only really tell after the fact. So hopefully it works.
Some questions or comments on that? Okay, Alex. And also I encourage the rest of you to think of some questions as well. I think it's an important part of the exercise. So
I know in America it was sort of a controversy with the actions that Ben Bernanke and the Fed took. Do you support the increased action that you said Ben Bernanke took, that he stepped beyond the normal bounds of the Fed, or do you think that he overstepped his limits?
I think what they need to do is they need to put in place guidelines. They should keep what they usually do, but this was such a dire situation that they didn't want it spiraling out of control like it was in the Great Depression. So I think they did stop that from happening, in which case I think they were right to do it. So, but I don't think that should be a normal thing.
So you think that even though he overstepped?
Sorry, Alex, can we, I think there's a question right here, and we're almost at the end of the time, so if you don't mind, let's give Gladys a chance to ask a question too. Sorry to cut you off, but yeah.
Are similarities in the way the US and the EU went about in their bailout, agenda? What are similarities?
I think similarities are that they are giving money to people in need, like the US gave to AIG and other companies to help them on their feet so things wouldn't keep going. And the EU has done the same, not in the same time frame, unfortunately, with Greece and Ireland. I think maybe if they stepped up a little bit sooner, it might not have gone so bad. So the fact they're giving money is
Time for one last question. Okay.
Yeah, I guess I'm just curious for more of a direct comparison, contrast kind of thing. Like, what did the U.S. do that the EU didn't do, and like, what was kind of?
Well, the U.S. also has the U.S. has both fiscal policy and monetary policy that's the same. Where in the EU, the countries have their fiscal policy and the EU has their monetary policy, so they're different. And what happens is in the EU, the countries are trying to do the fiscal policy and then it's not working, and then they're going to the monetary policy. And I think if everything was done faster, it would help speed things up. But since there's such a time lag between the fiscal and the monetary changes, that's where the big difference lies.
Good. So, I mean, just to kind of emphasize that as you're saying. I mean, in a word, the big difference is stimulus in the U.S. and it's bailout austerity in Europe. So it's bail out the banks, but then cut spending on all kinds of things. Where in the U.S. there's more of an ability for the government to bail out, but then also stimulate, which of course increases debt, but it's a hard choice to make. There are negatives to both. Okay, well, thank you very much. Thank you everyone for such good questions.